How did the 1970s great inflation impact commodity markets? Imagine a time when prices seemed to shoot up faster than most people could keep track of. That was the 1970s, a decade marked by what is called the Great Inflation. This period changed how commodity markets worked in big ways. For investors and everyday folks alike, understanding this era helps explain why raw materials like oil, wheat, and metals suddenly became so valuable. During those years, commodity prices soared at rates never seen before. For example, the overall commodity index more than doubled between mid-1997 to mid-1974. Some products like sugar and nitrogen fertilizers increased more than 5 times their previous prices. Agricultural goods like wheat, corn, and soybeans hit 20-year high prices, with many reaching record levels. This was a sharp turn from the oversupply conditions seen just a few years earlier. What drove these huge jumps? Several factors came into play. First, global demand for grains and oilseeds surged. The Soviet Union bought large amounts of grain, which pushed prices higher. Many other countries also increased their grain imports, especially those with centrally planned economies. Wheat exports from the United States, Canada, and Australia increased significantly, but at the same time, stocks of these crops were shrinking. For example, Australian wheat stocks fell 93% from 1970 to 1971. Geopolitical events made things even more intense. The Arab oil embargo in 1973, caused by the Yom Kippur War, made oil prices nearly triple. Oil-exporting countries like Saudi Arabia cut production and banned exports, which made energy costs skyrocket. This energy shock affected everything from farming to manufacturing because transportation and production costs went up. Later, the Iranian Revolution and the Iraq-Iran were added to energy price increases in the late 1970s. Currency movements also played a role. The U.S. dollar depreciated during this time, making commodities priced in dollars more attractive to buyers abroad. Oil-rich countries had large reserves of petrodollars, which they used to buy more commodities and influence markets further. Governments tried to control prices by imposing export taxes, restrictions, and tariffs. These policies often made shortages worse and kept prices high. Inflation was running high in the economy, with the U.S. inflation rate reaching around 14%. This made everything more expensive, including commodities. When inflation rises, the real value of bonds and savings drops, but commodities often become more attractive because they tend to keep pace with inflation. During this time, gold prices increased nearly 7 times, even after adjusting for inflation. Oil and wheat also saw strong gains, rewarding those who invested early. This period shows how inflation, demand spikes, supply limits, geopolitical shocks, and currency changes all work together to push commodity prices higher. For investors, the 1970s proved that raw materials can offer big returns during inflationary times. It also teaches us that understanding these economic factors helps spot opportunities when prices are rising fast.